So good morning, everyone, and welcome to this webinar on the impact of ESMA's guidelines on the use of ESG or sustainability-related terms in fund names. Please remember that the session is recorded. All your mics and cameras are enabled by default, but you will be able to raise any question you may have after the presentation through the Q&A box. So now I give the floor to the head of the Economics, Financial Stability and Risk Department, Stefan Kern. The floor is yours.
Thank you so much, Cicely, and a big warm welcome to all of you to this webinar also from my side. It's a great pleasure to see so many of you joining for our today's discussion, which is dedicated, Cicely just said it, to the impact of ESMA guidelines on the use of ESG or sustainability-related terms in fund names, which is a publication that we brought out just before Christmas and that we want to discuss with you today. Great opportunity, and you might have seen that the article actually forms part of a whole series of studies that we at ESMA have produced over the past years on the use of ESG terms by EU investment funds. First study back in 2023 documented, and this is an important first step, a sharp increase in the use of ESG language in fund regulatory and marketing material, including fund names. So this was the first element to start from. And then second, almost naturally, a year ago, we looked into the positive effect on investor flow of adding ESG terms in fund names. And then today, we are looking at the phenomenon and focusing on the impact of ESG fund name guidelines on the funds themselves and how they actually relate to the guidelines, how they implement them, and what impact it has on the naming conventions. The ESMA guidelines themselves on the use of ESG and sustainability-related terms in fund names were actually published back in May 2024. These guidelines, you may recall, introduced exclusions and minimum portfolio thresholds for funds using terms such as ESG or green or social in the names. The guidance is aimed to address potential greenwashing in the fund industry by ensuring that the funds signaling sustainability through their names actually have sustainable portfolios. In today's presentation, we'll show that the guidelines have in fact proven effective in improving the alignment between the fund claims on the one hand and the portfolios on the other hand. So that is a really encouraging signal for our work here at ESMA, and we're pleased to provide the evidence to you. The details will be brought to you by Maximilian Ludwig and Federico Piazza, who are analysts at our department here at ESMA, and who co-authored the piece. They will present the results of our analysis, which mainly focuses on the fund name changes and on portfolio exposures to fossil fuel activities. The presentation will be followed by a few short remarks by Patrick Carlson, the Senior Policy Officer at the Investment Management Unit of ESMA, who leads ESMA's work on the Sustainability Finance Disclosure Regulation. And it's a great opportunity, I think, for all of us to actually, discuss both our findings on the guidelines as well as the guidelines themselves with Patrick. So Patrick, many thanks for joining us today. Afterwards, we will open the floor for Q&A, which will be moderated by Julia Mazzacurati, who leads in our department the analytical work on all ESG-related matters. To do so, we invite you to write your questions as explained earlier on in the outset by Cicely. We invite you to pose your questions in the Q&A functionality in Teams during the discussion, during the presentation, and after the presentation. So please feel invited to actively participate, ask your questions to us, and we'll be very glad to discuss with you anything that you've got on your minds. With that, I will leave the floor to Max and Federico, and I very much hope that we'll have a very good presentation and discussion. Thank you very much, and over to you, Max and Federico.
Thank you very much, Stefan, and thank you all for joining the webinar on, as Stefan has said, the impact of the ESMA guidelines on the use of ESG or sustainability-related terms in fund names based on the TRV article that was just published last year. I'm going to give you a brief introduction and some background on the topic, and then explain what we found on the fund manager's communication to investors. I will then hand it over to Federico, who will guide you through the second half of the presentation, focusing on the fossil fuel exclusions and our findings related to them, as well as wrapping up with conclusions and a policy outcome that we draw from this article. Just as Stefan had already mentioned, I will not be long on this. The article comes in a line of work that we had on fund names and specifically the use of ESG terms in those names. First with the growing share of funds adding ESG terms, then the positive effect on inflows after having added ESG terms, which was published last year, and then today's topic, how did fund managers react to the fund naming guidelines? And this will be today's session. Just as a brief recap, I guess you are mostly familiar with these guidelines, so try to not be too long here. We have the guidelines published in 2024 with application deadline for May 25. And what we have is a definition of a group of terms, ESG terms, and associated guidance for the portfolio of such funds. First, of course, funds that use no ESG related term in their name have no guidance, or no guidance applies to those. Then we have the category of social or governance related terms, plus also transition related terms in this bucket. And these set the basis also for the rest of the terms, with a minimum of 80% of the investment that shall be used to meet an E or S characteristic or sustainable investment objective. And furthermore, also introduce a set of exclusions based on the climate transition benchmark. So exclusion of controversial or companies involved with controversial weapons, tobacco, or companies violating social safeguards based on the UNGC or OECD guidelines. And lastly, an additional provision for funds using transition terms, which shall also pick investments that are on a clear and measurable path to transition. The second bucket is the environmental related terms plus impact. So these also include the term ESG as such. We have the same investment threshold as above, and also the CTB exclusions apply. This time also added on to the Paris-aligned benchmark exclusions. So we have also the exclusion of fossil fuel activities based on certain revenue thresholds. So for example, companies deriving more than 1% of their revenues from coal shall be excluded here. And lastly, for funds using the term impact, again, should be a positive and measurable impact in the investment. And the last group of terms that we have are the sustainable related terms, so funds using sustainability and the like. Again, same as above for the environmental related terms, the 80% investment thresholds plus the PAB exclusions, so exclusions of fossil fuel companies based on several revenue thresholds. And on top, clarified in a Q&A, that we have the minimum of 50% that shall be invested in sustainable investments. So what these guidelines, or what we found for the guidelines once they were introduced, is of course a strong market reaction, and that has also been documented extensively by market observers. So what we see here is a chart from the past, from the last TRV, ESMA TRV, where we noted that, of course, a growing number of funds actually removed ESG words as a reaction to the guidelines. So we see the green line here picking up notably towards the application deadline, which was May 25. The chart is in cumulative numbers. So that means here we register about close to 900 funds that removed ESG terms over that period. At the same time, we also see a few that changed to a lower category, while there are still some funds, which is the blue line, that added ESG terms over the same period. On aggregate, for our sample, the number of funds using ESG-related terms in their names decreased from about 4,000 ahead of the guidelines publication to about 3,300 after the application deadline for the guidelines. And what we will focus specifically on in this presentation, aside from the name changes, is also the dimension related to the exclusions that we had mentioned in the summary of the guidelines before, and which Federico will give you more information on later. Just on the data that we will be using for that. So the part that I will be taking care of will be mostly about the first bullet, so the shareholder notifications, where we manually collected shareholder notifications that made an explicit reference to the ESMA guidelines from the websites of 25 of the largest EU fund managers. And the aim here was to understand, aside from the name change, what other changes were introduced to the funds in reaction to the ESMA guidelines, notably on the let's say investment thresholds, so on the investment policy side, updates to investment thresholds, and most notably the exclusions. And then in the part that Federico will guide you through, we'll rely on Morningstar portfolio holdings. So here we expand the sample from the funds mentioned in the shareholder notifications that I will talk about to a broader sample of EU funds using ESG terms in their name based on Morningstar portfolio data. And for the work on fossil fuel related exposures, we will rely on Urgewald, which is a German NGO who produces a list of companies that are involved in fossil fuel activities. Plus, in a recent update, also have included a PAB assessment at company level, which is the basis for our, let's say, exclusion list of fossil fuel companies, but Federico will tell you more about that in a minute. So to get into the topic, just a short stylized overview of fund managers' communication options as a reaction to the publication of the guidelines, a bit to structure the thoughts and also how we analyze those shareholder notifications that we collected. So upon publication of the guidelines, fund managers, of course, could assess whether they were in compliance or not in compliance with the guidelines. And then as a reaction had two main options: either change the name or update the investment policy. And however, of course, if the fund found itself already in compliance with the guidelines, then no action was required to meet that new supervisory expectation. And for funds not in compliance, changing the name could mean downgrading, which we call downgrading here, means moving to a term that has less stringent guidance attached with respect to exclusions or portfolio investment thresholds, or remove all ESG terms to not have to stick to any of the guidance issued. And for otherwise, and there are of course also overlaps between those options, between, let's say, downgrading and updating, for example, the investment policy, meaning that funds could change their name, move to a group of terms with less stringent guidance attached, but still add exclusions that are expected under this group of terms, or adjust the portfolio thresholds accordingly. And what we saw in those shareholder notifications that cover 900 funds from the, as I said, largest 25 EU managers, is that in practice, there were also overlaps between those options, so they are not mutually exclusive. Funds changing the name also updated their investment policy in some cases. So overall, we find that the funds mentioned in the shareholder notifications changed their name, or 65% of those funds changed their name, which equates to 600 funds. But at the same time, we also find that 57% of the funds also updated their investment policy. And between those two groups, there's an overlap of about 1/3 of the funds changing their name that also updated their investment policy. So aside from just the pure name changes that we saw, for example, in the chart also from the TRV earlier, we have a lot of activity also on the investment policy updates. Turning to the fund name changes and just a few headline findings here from the shareholder notification sample. We saw that most frequently observed, as in the TRV chart, it was already indicated, were of course the ESG term removals. So about 61% of the funds that changed their name removed all ESG terms, while another 21% moved to a lower category, or let's say to a group of terms within the guidelines with less stringent guidance attached. And also those name change patterns we found differed between actively managed and index tracking funds. We found a majority of index tracking funds removing ESG terms, often of course linked to the tracked benchmark changing its name. And at the same time, also a relatively larger share of active funds opting to merely downgrade to a category with less stringent guidance attached. And to zoom in on those changes, just a small chart that shows basically the movement between those categories. So on the left-hand side, we have the name before the fund changed its name. So this is only the sample of name changes, so 600 funds. And then to the right, we have the new name, again sorted by the new group of terms according to the ESMA guidelines. And what we see are two main moves. We have lots of funds that removed all ESG related terms coming from the environmental and impact related category, most of those using ESG term. And further, we have sustainability related, previously sustainability related funds that either downgraded to the environmental impact related category, so replacing, for example, sustainable with ESG, or also opting to remove all ESG related terms in that case. And at the same time, we of course end up with a lower number of total ESG related terms in that group. As we said, 61% removed all ESG related terms. However, in this group of no ESG related term, after the name change, we see also some new signals or new terms that are introduced to the fund names. And those are, for example, scored, screened, or combinations thereof. We have select, advanced, or committed. And many of those are actually driven also again by index tracking funds, and often also again by renaming of the underlying benchmark tracked. And the last category here is, of course, also funds that removed the ESG related term and replaced it with no direct word, but just basically opted to scratch it out of the name. Turning now to the second part of our analysis, of course, is the analysis on the exclusions and also the motivation for why we collected the shareholder notifications in the first place. So what we found is that, as said previously, 57% of the funds actually had an update to their investment policy. And we found that most of those concerned adding new exclusions or an explicit reference to such exclusions. In total, those concern 475 funds, and the large majority of those funds adding exclusions added a reference to the PAB exclusions, which is also consistent maybe with the picture that we saw before, where also more of the funds moved to the environmental related category to which the PAB exclusions apply. And Then we had another 179 funds. Of course, again, there are overlaps between those 475 and the 179 funds below that also made adjustments to the minimum investment thresholds, which often relates to the 80% minimum investment threshold to meeting E or S characteristics or a sustainable investment objective. And again, in line with also the findings for the fund name changes, the pattern again differed between actively managed and index tracking funds. And what we see is that there were less investment policy updates for index tracking funds, which is of course also consistent with most index tracking funds removing all ESG terms, meaning that no guidance applies to that new name in the end. And at this point, I would hand it over to Federico, who will take over for the focus on fossil fuel exclusions.
Yeah, thanks, Max, and good morning to everyone also from my side. Now I will guide you through the second part of the article, and from here we slightly change the scope. We focus mainly on funds fossil fuel exposure breaching PEB revenue threshold. So we first want to assess and to quantify what we call here the compliance gap, and that is the portion of each fund portfolio which is invested in assets that are excluded under PEB. So in this case, fossil fuel related activity. So within this first step, we make use of portfolio holdings data from Morningstar, and we match this data with Walgeval data, which, as mentioned by Max before, provides some information on companies exposed to fossil fuel activities, and now in their most recent lists also have a binary flag to assess whether such companies are in breach of PEB set revenue thresholds. We do that on our portfolio snapshot of around the 4,000 EU funds, which were the funds employing ESG related terms prior to the guideline application, and then we map the holdings with this list of company in breach of PEB revenue threshold. And we do that as we plan to use the compliance gap as our proxy, let's say, for how far a fund would need to adjust their portfolio if it wishes to retain the specific environmental or sustainability related term in its name, so to adopt the guidance provided by the guidelines. The first finding with this setting is that no, back to the slide, prior slide, Max, please. The first thing we found is that more than half of ESG named funds have no exposure whatsoever on companies in breach of PEB thresholds. But at the same time, the remainder, so this other almost half, do have a non-zero compliance gap. So we have, let's say, an important portion of funds for which the guidelines have, let's say, create a specific choice set for a fund manager, and that is either adjust the underlying portfolio, so try to reduce the compliance gap, or to change the name of the fund. And with this in mind, and with this compliance gap measured, our natural follow-up question is how manager tries to respond to this. And this is what we analyze in the following slide. We try to examine the managerial decision, as you can see in the next slide. Here the idea is, what would the fund manager do in reaction to the guidelines? Remove ESG terms or return the terms and adjust the portfolio? So we first estimate a logistic regression where we want to understand whether the size of the compliance gap, so the exposure to company breaching PEB fossil fuel, could be a predictor on the fund manager decision to change name. And we then also in the annex of the article, there's the full model specification, but there's a bunch of controls also including all fund characteristic and fund strategies. What we find, and this is the top left chart forward. First is that there is a strong positive relationship between the compliance gap and the probability of a name change. We considered some different specification. Here, the one you see in the chart is, let's say, a continuous. So the higher the exposure to fossil fuel related company, the higher the probability of name change. We also tried a similar specification just with a binary non-compliance variable that is 0 if the fund is not exposed to any PAB fossil fuel threshold, and 1 if this is the case. And both specification lead to a similar result, and more in general to the finding that the higher the exposure to fossil fuel, or if this exposure is present, the higher the probability of the fund changing the name. Moreover, and this now we'll switch to what we present here in the bottom chart. We also observed, let's say, a behavioral difference by those managers that are headquarters in the US with respect to the one headquartered in the EU. And the reason why we want to check that is also to test whether there's any influence for what we call here the anti-ESG sentiment, which is let's say more prominent in the US. We also brought a few analyses on this in the latest TRV. And here we wanted to understand whether the location, the headquarter of the fund manager, not specific EU branch, but the broader, let's say, asset management company, could somehow influence manager decision. And what we observe is that US headquarter managers are about twice as likely to rebrand compared with non-US, so with mainly European fund headquarters. How to read the chart is on the left-hand side. For those funds that have no exposure to fossil fuel, you can see that there's a similar probability of name change in that both fund managers do not have, let's say, impelling decision or impelling divestment decision. But then for those funds on the right-hand side of the chart, which are exposed to fossil fuel, then you see that US-based fund manager, that is the yellow bar, do have on average a higher probability of name change, provided these funds are exposed to fossil fuel. So now we, so to say, established more or less the decision pattern. What we wanted to quantify next is the specific impact on fossil fuel exposure, on the more general, let's say, amount of assets that are invested into fossil fuel in breach of PAB threshold. And in these slides, we try to assess the exposure to fossil fuel activity by ESG fund names. And we show this in, let's say, two different set of impacts. We found a more mechanical and main impact from the fund renaming activity. As we said, an important number of funds decided to remove this name. And just by this name removal, as quite often the highest exposed fund decided to remove ESG terms, we saw an important reduction in the aggregate of fossil fuel exposure of funds still using ES sustainability terms. And this is evident in the gray bar in the top left chart. The right bar, you see there is this important chunk which accounts to around 11 euro billions. That is the amount of investment into fossil fuel activities of funds that decided to change name and remove their reference to environmental sustainability related term. So let's say I said mechanical, as this is purely happening. So by reclassification, you have an important decrease in the overall amount of assets, of fossil fuel assets held by these funds, which has decreased from 17 billion to 6 billion. At the same time, we also observe a more gradual impact from portfolio divestment, as those funds that decide to retain and so to keep the ESG term have actively divested, so to reduce what we define as compliance gap. And you can see this in the bottom chart, as the exposure to fossil fuel activities by this cohort of funds have fallen by 40% since the publication of the guidelines. Now, on more general terms, as you can see also in the chart, all EU funds have somehow actively reduced their exposure, but none of this fund category have done so at a similar speed or a similar, let's say, impact as those funds which decided to retain the ESG term and had a non-zero, let's say, compliance gap. I think I can move to the next slide and we can just wrap up also in the interest of time what we try to present to you today. And first we perform, let's say, a study on the reaction of fund manager to the guideline, and we saw that one common reaction was to remove reference to ESG in fund name as the number of funds using ESG terms declined from 4,000 to around 3,300. We also saw that fund managers made use of, let's say, a secondary or other compliance channels on top of the name changes or the name downgrade, and this is the policy updates. We saw it was quite common from fund managers to add PXB exclusions and to add in some case add some other adjustment to their portfolio thresholds. In the second part of the article, we tried first to identify what we call a compliance gap, and we saw that this specific compliance gap, that is the how far a fund needs to divest in order to follow guidance, is a good predictor of the probability of rebranding. So it's an information that fund managers take into consideration. And we saw also that US headquartered asset management company were more likely to rename with respect to their non-US peers. We also found that finally funds that retained ESG terms undertook a faster divestment, at least in relative term, from fossil fuel activity, so to try to improve their portfolio alignment to the PAB exclusions. On the following slide actually, some of the policy outcome which we define also in the article. On one hand, we found that the guidelines have somewhat increased market convergence around the use of ESG related terms, and we saw this also through the important activity around ESG fund name changes. We also found that they should help reduce potential greenwashing perception, as now funds are prevented, at least in principle, to use sustainability or environmental terms and at the same time have a non-zero exposure to fossil fuel activities in breach of the exclusion that are mentioned in the guidelines. And finally, and we saw this in the last slides on the impact of the guidelines, there has been a general improvement in what we call here the portfolio greenness, which is the exposure to fossil fuel related company, as the funds, the cohort of funds we decide to retain their name has also on parallel actively divested from what we call here polluting firms, that are those companies in breach of the PAB exclusions. And I think also in the interest of time, I can stop here, and on my side and on Max's side, very many thanks for being here and for your attention. I will now leave the floor to Patrick Carlson, as mentioned, the Senior Policy Officer at the Investment Management Unit here in ESMA, and he very much leads the ESMA's works on the SFDR, and he will just provide a few short remarks before we move to the Q&A session. And so if you have any question, please feel free to also post it in the specific section. And Patrick, I'll leave it to you.
Thank you very much. It's a great pleasure to be here. Good morning to everyone. We developed these guidelines in ESMA as a way to protect investors from misleading fund names when it comes to ESG and sustainability related terms. we had identified the use of the disclosures in SFDR Article 8 as one potentially contributing to greenwashing risk, because its intention was to provide greater transparency on sustainability, rightly so, to investors. But in the absence of clearer categorization, these disclosures were used as a signal, as a kind of quasi-label, basically. And this is what we were trying to address with these guidelines. So it was extremely good to see this analysis by our colleagues in the economics department. We are very grateful for this, and it's very good to see that the results justify the reasons for launching the guidelines. We can see that name changes have occurred as a result of the publication of the guidelines, and that the guidance is being followed, and that investors are better protected as a result, whether by more clear names, not giving an impression of sustainability or ESG characteristics or factors, or by better compliance with some minimum criteria for those funds, with those terms in terms of exclusions, especially CTB and PAB exclusions, depending on the type of term used, or the 80% thresholds of investments used to meet the characteristics or objectives of the fund. So indeed, when we are sometimes criticized for not analyzing the impact of our measures, I think this is a good illustration that not only did we try to analyze the potential impact prior to launching this, but now also with this research, we can analyze some of the impact after launching and see what the results have been, which are, from our policy perspective at least, pleasing. Also, with regard to SFDR, it's good to see that the European Commission, in their proposal launched in late November last year, took on board several of the ideas we had in the guidance for financial products that have sustainability or ESG features. So that's good to see, of course. And with regard to the future of the guidelines themselves, obviously they remain in effect and applicable for the time being. And what we want to do then is, once the direction of travel and the political agreement on the SFDR review proposal is clear, we want to make a determination that the protection of investors is similar to what we have provided for under the guidance. And then, in an ideal scenario, we then abolish the guidelines quite simply, and there will not be two regimes in place at the same time. Simply, the guidelines will have been effectively replaced by new categories, and not just the categories themselves, but also the investor protection elements of the new proposal, specifically the naming restrictions for names outside the categories, that those reflect the guidance. And once we determine that the level of protection is similar, we can then remove the guidelines, and we can all move ahead with a single SFDR regime. That's the ideal scenario, but of course, let's not get ahead of ourselves. There's still a political process to go through on the SFDR side, and then we can make a determination after that. But coming to the very interesting analysis and research that you've done, perhaps one question I could ask you, Federico and Max, before we turn over to questions from the audience, is based on the data that you looked at, do you think that the exclusions, the PAB and CTB, and specifically you spent a lot of time looking at the fossil fuel exclusions, quite rightly so, in the PAB exclusions, did the exclusions or the 80% threshold prove a bigger challenge for those managers with affected funds that were not in compliance previously? This is the compliance gap question, essentially. Was it the 80% threshold of investments meeting the objectives or characteristics, or was it the exclusions? Now, I can imagine that the data is easier to track on the exclusion side, but I was wondering whether you had any insights on which of the two key elements of the guidance proved a greater challenge.
Thanks, Patrick, for the intervention. And just before we take your question, I want to remind people that they can write their question down in the Q&A function, and then we'll go through some of the questions here. So my name is Julian, and I'll actually reply to that question. I work with Federico and Max on the article and the analysis. So we actually did not test in the article and in our work the 80% threshold. I think anybody who has worked on the guidelines or related to the guidelines is aware of the difficulty, of course, of assessing this. You have various measures or ways to approach the question. So how exactly do you test for the question? So 80% of the portfolio needs to correspond to the name. It obviously depends on what you have in the name. It depends on your interpretation of the specific word. It depends on the fund strategy. So our work has really focused on the exclusions and more specifically on the PAB exclusions. And I think the result that Federico presented during the second part of the presentation shows that from an investment manager's perspective, the PAB exclusions were, in a sense, quite demanding because, as we could see, that this led a number of fund managers to decide and rename their fund as opposed to following the exclusions. Now, why is that? We can only speculate. This is not something we have asked fund managers specifically. But of course, if you introduce exclusions in a portfolio, that means you reduce your investment universe, which has implications potentially for the volatility of your portfolio, the returns, possibly also brings you closer to concentration limits and so on. So it has a number of implications, which if you don't want to modify your entire investment strategy, then probably makes it easier to change the name of the fund compared with revamping entirely your portfolio. So that would be my response to your question. And then let me now turn to some of the questions that were asked in the chat. So I'll start with the first one, which was asked quite a little while ago. And it's a question from Nadia about the article stating that adopting ESG terminology attracts additional inflows in quarters following the name change relative to other funds, and to what years this is relevant. So this is actually something that is based on the previous article that we have published, and I'll post this in the chat so you can actually see for yourselves. So the analysis was conducted, we published this piece of work in April 2025. So this was based on data going from 2016 through the end of 2024. Obviously a different era, as you might say, both in terms of flows, international context, and generally, I think, appetite for ESG products or interest in sustainable finance. We have not tested this again, so we're not in a position to say whether it still attracts additional flows. My guess would be that the picture is, of course, different, and that's something we're planning to have a look at probably later this year. But for the moment, I'm afraid we don't have an answer to that specific question. Now, turning to a second question, and this one is probably for you, Patrick. Alessandro is asking, with reference to the new signals observed, so adoption of words like scored, committed, and so on, in terms of terminology used, could it be seen as an attempt to circumvent the stricter regime established by the ESMA guidelines on the use of ESG sustainability-related terms in fund names?
Yep, sure. Happy to respond to this question. It's a fair question indeed, and an issue we encountered and discussed during the consultation phase in 2022 already, and is basically this specific question of the reaction to the guidelines and the potential use of alternative terms that are not as clearly ESG or sustainability related. We resisted having a clear-cut list of terms that are caught and publicizing such a list for the very reason that we were worried about this kind of circumvention, that if there is one single list and all you have to do is choose a relatively similar term outside that list, and you can still circumvent the rules and give this signal of sustainability to investors without conforming to the guidance in terms of the exclusions or 80% threshold. And that's why we wanted to avoid it. Now, having said that, obviously, it's difficult to determine when a term does give that signal. So scored or committed that you refer to in your question indeed is referred to in the article for that very reason, that it's not very clear cut. I think that if you look at it from the glass half full perspective, you can say that at least those terms are not as clearly signaling greenness or sustainability by their very nature. So at least that's, is a sense, some achievement that, you know, if those firms wanted to use terms that were more clearly sustainability or green related, then they can't do that anymore. They have to use more ambiguous terms still. But then, you know, the determination has to come then is if it's simply used as a circumvention, that may merit more supervisory attention from the local supervisors then of funds with those kinds of terms in the name, just to ensure that they are not only using that term in a way to circumvent the rules. And that's why we don't have a list to give that kind of supervisory discretion to the NCAs locally to make that determination. The key test is, does this name give an impression of sustainability or greenness to the potential investor? And that's basically how we want the supervisors to approach these kinds of issues.
Thank you, Patrick. Now let's turn to the next question, which is about the use of the global coal exit lists in relation to the hard coal exclusion. And the question is about the fact that this list only covers thermal coal, and therefore met coal is not included in the list, and these specific exclusions are not covered. So perhaps, Max, could you say a word about this?
Sure, thanks, Ria. I mean, of course, in this case here, we use the GSAL, and it, of course, comes with some limitations and also some assumptions attached. And as you're aware, there's, of course, probably a difficulty in sourcing comprehensive information, and the GSAL in that case, at least, was the most comprehensive source of information that we could find for the purpose of this article for broad-based analysis, also with regards to the further exclusions that we have on gas and oil related companies, which is why we chose to use the Urgewald as a source in this case. But of course, it does not delimit basically the scope of the exclusions by the data source that we used here.
Thanks, Max. We have a couple of questions about flows. Unfortunately, the article very much focused on the impact of the guidelines, so we haven't actually looked, as I was explaining earlier, at what is now the influence of adding or removing terms on net flows following the introduction of the guidelines. But this is something that we're planning to have a look again at in the course of this year. So unfortunately, we're not in a position to answer these questions. Perhaps a question to you, Federico, now from Adam. Is there an explanation why new funds using sustainability-related terms initially come from no ESG-related terms? So that's chart 2, and how we treated combinations of terms, for example, sustainable and transition, in the classification.
Yes, sure. I can take this. Maybe starting by the first question, and I think this refers to the Sankey chart, in which indeed there were a bunch of funds that had no ESG related terms and then moved to a sustainability related or an ESG related category. This refers to small number of funds for which the fund manager decided to add a specific ESG related terms, which was not present at the time of the publication of the guidelines. So specifically one fund manager, I think also some market observers picked up the news, decided, given that probably their funds, while not having a specific and explicit reference in the ESG, ESG related reference, were still quite very much in respect of the guidance provided by the guidelines. So they saw the possibility to just add a specific reference to the name. But as we saw, this only was done by a handful of funds with respect to a higher number of funds, removing the related term instead. Moving on to your second question. So as you rightfully pointed out, there are some instances where fund names enclose more than one term, and in which potentially this term is pertains to different, let's say, category within the guidelines. So while there has not been any specific case of sustainable end transition within the same fund name, transition was quite often used in conjunction with an ESG related word, as for example ESG transition. When this was the case, we would still consider that specific fund as a transition related fund. So abiding to the guidance which was set for those funds enclosing a transition related word. As far as some other instances of combination of word we found, this was mainly the combination of either a E related word and a sustainability related word, or a social and E or sustainability related word. And when this was the case, we always took into consideration the word which pertains, let's say, to the portion of guidelines which refers to a more stringent guidance. So for example, if there was a social related word and an E related word, we would then consider that fund as within the cohort of funds using an E related word, as there are a few other guidances set down for these cohorts of funds.
Thank you, Federico. We probably have time for one more question. There's a question about MiFID, which I'll probably ask Patrick to answer. But before we get there, there's a very simple question about the reference to social washing. And just to clarify, we've been using the term greenwashing relatively loosely in the sense that this would cover basically the misleading information provided on sustainability aspects. So it does not just cover green aspects, but also social impact and so on, and other forms of washing that you can imagine related to ESG angle. So the article covers greenwashing as well as social washing and so on. At least that is the intention. Now turning to the MiFID related question to you, Patrick, then regarding managed portfolio. Currently, as per the ESFDR, this seems to be defined as a product. Does this mean that such managed portfolios need to comply with same or similar naming guidelines on using ESG and so on terms in the name, similar to what applies to funds? Yeah, please go ahead.
Yep, sure. No, happy to take this. I like your question, Spiros. You say that this seems to be defined as a product. It not only seems to be, but very much is defined as a product under SFDR. So that's certainly the case today. I mean, this basically is a question about the current scope of the guidelines, which I can confirm it only applies to investment funds. So it's very clearly laid out in the guidelines. It's AIFs and UCITS. UVECAs, UCEFs, etc. Any kind of the AIF subcategories that exist are also caught, of course, but because they're AIFs, essentially, also alternative investment funds. Sorry. So this does not affect portfolios, even though they are SFDR products. We've received this question a lot, and we considered it obviously during the creation of the guidelines whether this should apply to all SFDR products, and we would have done that then jointly with the other ESAs in the joint committee, but we decided that the most pressing case for action was in investment funds. There are far more UCITS and AIFs that are disclosing under Article 8 or Article 9 than any other financial product under the SFDR definition of financial products in Article 212 of SFDR. So that's why we took action most urgently in the investment fund space. Clearly, though, it has relevance to other sectors, but not applicability to other sectors. And we wanted that relevance to be reflected later in the SFDR 2.0, and that is indeed now happening under the Commission's proposal. So that's good to see. So that won't apply. Now, the second part of your question, indeed, relates to this, scope of SFDR. That's not the purpose of today's call, so I won't spend too much time on it. But indeed, as you may have seen, the Commission proposed to no longer have MiFID portfolios, in other words, portfolio management services under MiFID as a product under SFDR. So then that would mean that none of the SFDR product rules would apply to portfolios anymore under 2.0. But again, that's subject to discussions in SFDR in the Parliament and Council. So let's see what the outcome is before we know the final state. Just very quickly, if I may, Julian, sorry for taking one more minute, but there was a question on depository duties under the guidelines, and I mean, the depository duties do not differ for the guidelines than they do for any other aspects of the UCITS and AIF. So the depository duties are set out in the UCITS directive and the AIFMD, and delegated regulations under those, and of course national implementation of the directives, and that remains the same for the guidelines, because basically these applies to UCITS and AIF. So there's no differing or additional depository duties for the guidelines. It's the same as for any other aspects of the UCITS and AIF.
Thank you, Patrick. And I think this brings us to the end of this webinar. It's 10:59. Apologies to the people who have asked questions that unfortunately we're running out of time, so we won't be able to answer, but many thanks to all of you for attending the presentation and for your very interesting questions. With this, I wish to everyone a very good day, and would like to thank Patrick, Federico, and Max for the presentation and the discussion. Thank you.